Thanks for coming back to our next edition of Econ Talks. Gareth, over the last few weeks, we've had a little bit more information coming in about the state of the economy. We had inflation coming in at 1.4%, a pretty strong result, certainly compared to where we might have thought the numbers were sitting. Pricing pressures a little bit heavier than we might have thought. Supply chain issues coming in there, construction capacity constraints, and some of the changes that we're seeing in the tourism sector seeming to influence that. But we've also had unemployment that's come in at a much better result than expected. I mean, what does all that mean for the Reserve Bank's outlook, and what are we thinking when it comes to interest rate settings and monetary policy this year?
Yeah, obviously you've had massive monetary stimulus thrown at the economy through 2020, and that's been one of the reasons I think why the outcomes have turned out to be pretty good, because it has been effective alongside fiscal policy in terms of keeping momentum in the economy going. But it does now raise the question about where monetary policy goes to from here, and expectations of the OCR going negative, which were commonplace even 4 or 5 months ago. We've scratched those now on the basis that, like you say, there is just a bit more pricing pressure concern out there, but most importantly, you're not getting that weakness coming through in the labour market, and therefore, spending is going to continue on through the economy. Demand conditions are pretty good. And so it's now time to start thinking about, when monetary policy turns the other way. We've already seen the Reserve Bank just starting to taper off in terms of some of its bond purchases as well, which suggests that program will continue to wind down over the next few months. And then you've got the funding for lending program, which the bank instituted late last year. Not a lot of take up so far from the retail banks in terms of accessing those funds, but there could be still some coming through over the next few months as their existing funding tranches sort of wear off and they're able to access those lower cost funds. But again, I think given what the Reserve Bank is seeing through the economy, and the rest of us as well are seeing, they'll probably be starting to think about just how they wind those programs back over the next 12 months or so.
Yeah, absolutely. And like you said, sort of everyone, including us, have changed our call now. No need and no real prospect of any further down falls for the likes of the official cash rate or any other real loosening further of monetary policy. And I think just to unpack a few of those, like you've sort of indicated, that funding for lending, we're already sort of waiting a little bit to see how that unfolds. We saw that there's already been one big tranche, $1 billion drawn down by one bank. Soon after that, you have seen that the major banks have all dropped their 1-year fixed rate, special rate down to 2.29%. So you've seen a bit of a reduction in some of those fixed rates again, sort of as expected with some of those changes. And as well as that, we are, I guess, seeing that the banks are still, competing a little bit. There's still a bit of pressure there. But also we've seen that the Reserve Bank's been under considerable pressure from the government and from the public around house price gains, around how that demand has moved. And so although it's not necessarily going to be a key driver of their decision making, in the back of their minds, it's not going to be a bad thing if they don't have to cut interest rates further and therefore stoke even more demand and fire under the housing market. So the pathway for the Reserve Bank seems to have been, I guess, to put a floor under a lot of additional stimulus or any real changes. Like you say, though, the question is what is next? And I feel like, if we were to talk a few months ago, there was almost no real view of when interest rates could ever go up. Now, I don't think that we see those coming through very swiftly in terms of interest rates going up, but that's more the question on people's minds is what's the next move and in a sense, how quickly. Now, we've got the likes of Capital Economics and even BNZ now sort of musing about the potential for interest rates to start going up as early as 2022. I mean, what's our feeling there around how quickly rates could eventually rise?
Yeah, I mean, there's a bit of debate between us about just how strong those inflationary pressures might become over the next 18 months. You've got concerns about the sort of demand pressures leading to a bit more inflation showing through in the likes of the construction industry, probably most particularly in the near term. I'm a little more relaxed in terms of seeing those inflationary pressures as maybe just supply driven. We know there's still disruption going on with supply chains internationally, and the Reserve Bank is not going to react to those sort of pressures because there's nothing they can do about them anyway. They just hopefully resolve themselves over time. But yeah, it is difficult to work out the timing of when those interest rates go up. I mean, our official forecasts don't see anything until 2024, but certainly the risk would be as the economy recovers that you do start to need need to tighten conditions before that. And, the housing market may be one of the determinants that feeds through into those decisions as well.
Yeah, I guess you wonder as well when it comes to the Reserve Bank what their decision making will be. Now, apart from I think a 2.5% annual inflation increase a little bit earlier, in the last, I think it was about a year or so back, we haven't seen inflation get to that 2% midpoint that the bank is targeting. So in a sense, I think there's probably a bit of comfort from the Reserve Bank after undershooting for so long that perhaps we could overshoot for a period. So even if we saw those inflation pressures coming through a bit stronger, that might still say to the Reserve Bank, actually, we're happy enough to wait just a touch longer than otherwise, in a sense, before we start to change things. The other point, and this has certainly been something we've discussed with our economics team here at Infometrics, is that the case in a sense for pulling monetary policy lower is in a sense weak in terms of what it would actually do to the market. If you talk to businesses, they're not saying, crikey, it's too expensive to borrow at the moment. They're just so uncertain. And so, pulling those rates lower isn't necessarily going to change anything. The challenge, I guess, is that for businesses, given how long it takes often for those investment decisions to come through, you've got to sort of leave rates on hold for a certain amount of time for the change you're looking for, which is more investment, to actually move through and to start happening. It's not quite so quick as you cut interest rates and tomorrow everyone in a business goes and borrows. So in a sense, I think it's quite important to realise that although we might start to see slightly better inflation and similar, until we start to see that investment coming back as well, I think the bank's going to have a pretty balanced view on where that outlook is. Is that sort of fair to say?
Yeah, I think that's a good point. Businesses may be wary of the uncertainty, as you've mentioned, also wary of just the difficulty of getting some of that plant and equipment from overseas, given the disruption to shipping that's occurring at the moment as well. So, yeah, holding back on that investment. And I think, the Reserve Bank will be keen in terms of generating further potential or future potential growth in the New Zealand economy for that investment to recover from the downturn that we've seen. So, yeah, I think that's a really good point. The other point I'd make is from a business point of view now, monetary policy, you don't really want to stimulate things further by cutting interest rates because it is quite a blunt tool. And if we are, we know there's still uneven impacts of COVID happening both at a regional level and an industry level. And I think it's most appropriate that if you are going to sort of provide assistance or support for the economy, it comes through some of the fiscal channels where they can, much more target that support to the businesses that are still feeling the pressure at the moment. So, yeah, those are some of the issues that we're sort of grappling with both from a fiscal and monetary policy point of view at the moment.
Totally. Look, thanks for that, Gareth. I think, very important part of the economy that a lot of people are looking at is that investment sort of track, how interest rates are going to move. Is there ups? Are there downs? What is moving and how quickly? So important that we sort of keep abreast of all of these different issues, and we'll continue to monitor them and I guess provide updates out to the public and to clients as we sort of see those things change. Thanks for catching up. Always great to see you, and I'll catch you and everyone else on the next edition of Econ Talks.